Alright, welcome back to my channel. Sorry for not making a video in such a long time. I've had a lot of stuff going on, but now I'm back, did some research, and I got a comment from someone telling me to look into Fastenal, and funnily enough, I was actually looking into it, and now I've informed myself enough to talk about it for a little bit. And also, I want to thank you guys for watching my previous videos. I didn't expect that I would have gotten so many views, people listening to me talk for so long. But thank you for that. Anyways, let's get started with Fastenal. So Fastenal, it's some people say it's an industrial distribution company, so distributing any kind of products MRO companies need, so manufacturing, repairment, or any kind of machine or equipment producing companies need. But for me, it's actually more of a supply chain solution company. And here you can see one of their distribution facilities. I think the trailers still look very nice, and I actually like the logo and the whole like blue white design. It has a very nice feel touch to it. Let's get started by some history, as I usually always do in my videos, talk a little bit about the background of the company. So the company was founded by Robert A. Kierlin. He calls himself Bob Kierlin. He founded it with two other of his friends, and they got $30,000 put together. He raised that money by working at IBM. Previously, he did a MBA. First, he did a Bachelor of Mechanical Engineering, and then he got his MBA, both in Minnesota University, I think, or some university in Minnesota. He started working at IBM, and that's where he got money to start the company with his friends. Here you can read a little bit about him. He was also a senator, state senator of Minnesota from 99 to 2006, and right now he is quite old. He retired from the board of directors and when he was 76, and now he's pursuing philanthropic work. Still has a lot of Fastenal shares, but now he's not involved in the business. He's now kind of acting, he said, as a business mascot, going around the shops, checking out the distribution centers, talking to new management, to new leaders in the company, seeing like still how everything's going, but he's not that actively engaged in the business decisions anymore. So let's take a look at what Fastenal's revenues compiled off. So fasteners are the top one product. Fasteners being like any kind of little bolts or threaded piece of metals, let's say, that you use to produce any kind of equipment or machines, be it cars, be it CNC machines, be it windmills, wind turbines, whatsoever, whatever you need to put stuff together so it holds, right? These are fasteners. Safety supplies, so like gloves or any kind of personal protective equipment, um, any kind of masks, also tools like drills or let's say tool equipment like bits, janitorial supplies. I think they even have like mops and stuff, probably even a few chemicals here and there. Hydraulics and pneumatics, that's kind of self-explanatory. I think they also have like different types of hoses for hydraulics and pneumatics. Material handling, cutting tools, electrical supplies, any type of stuff you need for this kind of work. Electrical supplies, probably some like safety switches, fuses and stuff like that. Welding supplies like welding tigs and stuff like that. Tungsten, whoever knows what exactly that is, but yeah. So they sell quite a lot of stuff, any kind of stuff you need for maintenance, repair, production of equipment, machines, so on and so forth. Some of them they have some like original brands, especially with fasteners. They first started in 1968 as just a distributor, but with over time they started building their own production facilities. So they actually also sell their own brands, not only from third-party manufacturers, not third-party manufacturers. Let's say original products from other companies, so they also produce stuff themselves and sell it under the Fastenal brand or different type of brands they also have. So now I've told you like kind of what they do, what makes them so interesting because you'll think like, oh, what's interesting is that they sell stuff to companies to produce equipment. Okay, like every company can do that. That's not really, there's no mode there. Everybody can like crowd a few million, get some inventory going, and start delivering it to factories. Well, it's actually not that easy. And as I said, for me, Fastenal is not that much of a industrial distributor. Yes, that's like the nature of the business, but the business has really evolved to something different. For me, it is a supply chain solutions company, and I'll show you why. So these are actually their, let's say, their magic pie. It's this automated vending systems or inventory management systems. These are the top three ones: Fast Bin, Fast Stock, and Fast Vend. And you can kind of see what they are like. These are bins with different type of products. This is a stock rack, we could call it, and it has different like fastener supplies. Here you can see like some kind of oils or soaps at the bottom. Here you can see all the fasteners. Here, for example, you have some glue, some tapes, some different type of bottles, and like this might be janitorial supplies, right? And these are actually really ingenious. Bob and his friends started to do this actually quite at the beginning of the company, but the machines weren't really good. They started doing with vending machines. But back then in 1969, I think it was when they first started to like implement the vending machines. Their manufacturer was actually a company making tobacco vending machines, which were back then quite good. But the problem is with these kind of vending machines, which are supposed to keep your stock of fasteners, janitorial supplies, so on and so forth, they the electrical and mechanical capabilities back then were not as good as they are today. So that was way too far ahead of its time. The CEO after Bob, I think it was shortly before the IPO, like a few years before, they actually managed to implement this. But yeah, so that took a while. Companies like like having these type of stock inventory management systems on their production site. They back then like Granger and I think also MSC Industrial, they have more success distributing their product directly to the production site by, for example, trucking and so on and so forth, different type of transportation techniques you have there. So not having the inventory management system directly at the production site that only took off a bit later. But let's keep on going. Let me explain you how these things work. So I got this from one of their YouTube videos on their investor page. So the Fastbin, I think they have over 24 different altercations of these systems, like the Fastbin, and the Fast Stock. So you can use the Fastbin. Either they have a RFID, so they have a little chip at the bottom of the stock here, and like if you empty this, you just put it up there, and there's a software connected to this Fastbin, and the software realized, okay, so here, this WD-40, you can kind of clearly see it as WD-40. So I take the last one, I put the bin up here, then the RFID, of course, makes it gives us a signal, and this signal is registered and goes to a server where the Fastenal software is running, which is connected also to the company database. And now Fastenal knows, okay, we'll have to restock the WD-40. So they send off a truck, they load up all the other stuff they also used up or like are critically low, let's say, low inventory, and they stock it up again. And then the next time on my shift, my WD-40 is back there and I can take it out again, keep working. I don't need to call any type of person, ask them, hey, do you have WD-40? They'll be like, no, it's only deliverable next Tuesday. You have to call me, but like after my break, no. When it's empty, I put it up there. Next Monday, WD-40 is back. Automated inventory management system. They also have the same with infrared. They have like a little laser running through the box. So when the threads get used up, the level goes slower, and eventually the infrared system will go off and also alert the software. And also like let's say a kind of just very simple system. not very sophisticated, just a scale. Of course, if you know how much each of your product weigh, you can actually just measure the weight, and then you'll also know when it's empty or what the level of the inventory is. But of course, everything you need a single box for each type of product. Otherwise, this especially this one doesn't work. But actually, all of these won't work. All right. Here you can see kind of again the RFID um, sending a signal. You can even track how many threads there are in the box, how many fasteners there are in the box. Also here you can see the laser going below the minimal line, and the red one would be like the critical level. And also here the scale just weighing how many fasteners are here in this box. Here you can see how the Fastman system works. So you can either have a card, like maybe some of the companies you guys are working at, they have a ID. You should probably only use it to clock in, especially if you work at an office. But maybe you have Fastenal system in your manufacturing site, or you have seen it, and they can even use their employee card to actually scan and get different types of equipment, like this caulk tube, or they even have codes. I bet like every employee has their own code, and then each type of item has its own code. And here you can see the employee grabbing up safety equipment, gloves. Why is this interesting? Well, this is actually not only an automated inventory system, it's actually kind of creating a lot of data for the companies using this. So Fastenal knows exactly what you're using, at what time, and who is using what. So Fastenal knows that, and they can send it to, like they do, they make this data readily available for the customers, so for the companies using this, for the manufacturing companies. So you're kind of tracking your employees. You can kind of also see their productiveness. You can see which tasks they are doing, which equipment they're using the most, or for example, are they using their safety equipment? Are they like getting their earbuds and also like their gloves, changing them every few days, every few months, whatsoever? Like depends what type of facility you're working in, right? Is the janitor like maybe stealing a few fasteners, stealing a few of these things, or is he just using his janitorial supplies, right? Um, I think you can even lock out certain people of certain items, maybe if you like see them doing nasty stuff, right? So it actually creates a lot of data. It's very efficient. It can, let's say, of course, it's efficient, the system, but also you can, as an employer, you get a lot of data which maybe shows a few inefficiencies with certain employees or just in general with your manufacturing process. So it's actually very, very useful. And it's not, that's why I call it more of a supply chain solution company, not really industrial distributor, because yeah, it's multifaceted if you really think about it. It's a really good company that does a lot of stuff. So um, of course, for a product, like you're looking at these vending machines, these type of bins with the different type of detection technologies or detection, let's say, sensors. Um, it's all nice and fancy, but except the data, there also and like the automation, there also needs to be a cost, um, let's say, a cost offering for the customer, right? Like they got to save some money. Like in Costco, the customer pays a certain fee to be able to enter Costco and purchase at Costco, and that's why Costco offers really good deals and also like nice products and like the treasure hunt experience. But this video is not about Costco, but like you spend some money at Costco, but you also get some back. Cheap gas, nice products, good deals. It's the same with Fastenal. You spend some money, you get the vending systems. Of course, you had to pay for the equipment, but you had to pay for the equipment either way, no matter what. If you buy it from Granger or from MSC Industrial, but it's all about these little services, this, the data, and also the cost saving. So if we look at this, um, average total cost of ownership. analysis, right? So Fastenal right now is all about this on-site locations. They do also have some shops, some branches, which are, I think they're even business to consumer, but usually they're like business to business. They have different two different type of locations. So they have, um, let's say, kind of how do you call it, normal distribution shop, in which they don't have really a big showroom. They just have the products there. You can go in there, pick up your stuff, go away. And they also have some showroom shops in which they show like different every type of product and like niche fastener and janitorial product and safety product you can imagine. So like when you pass by there, you'll see it and be like, oh wow, they do have those stuff. We don't necessarily need to order from these guys. We actually just have to ask Fastenal. They'll have it for us. Um, that's kind of been the value of this dual structure of the offsite of site branch. And now back to the onsite branch. Um, so uh, these are kind of the different saving. So the total cost of ownership, it would also be like the time saving, cost saving, and also like personnel saving goes in with the time saving because you don't have a person ordering. So 47% average reduction in the cost to source product because you don't have an employee, you don't have someone in the office working like having to communicate with the production, having to run a system, a communication system, be it a database, any kind of inventory management system. And the guy who needs to, a person who needs to learn to study the system, how it works. No, you like, there's the worker, right? Goes to the machine, picks it out, and then the machine, the vending, the automated inventory system knows exactly, hey, I empty. Fastenal, bring me this and this product, right? Also, they have average reduction in inventory carrying cost because Fastenal is kind of carrying the inventory for them in the vending machines in these bins, right? Vendor reduction. They have less vendors. Fastenal just gives them everything they want. 36% reduction in employee travel time. The employees don't have to maybe themselves drive around to procure any kind of tools or fasteners. They just walk to the vending machine and get it. 20% average consumption reduction for vending. Um, so what I understand by that is now that the employee is being monitored, maybe he's a bit more efficient in production. I wouldn't want myself to be so monitored, but you can see as, let's say, a shareholder, why this might be of great interest to you in a production company. It's always better if you're especially in a big size, if you're using thousands of fasteners a day, if your employee is very careful with them, right? Um, but also you don't want to save, you don't want them to save them on safety equipment, right? You want them to be safe because sick days they're always more expensive or less worker. Not being able to produce a product, sending to the customer is always more expensive than a few gloves more. 61% average reduction in costs associated with material handling and distribution. Yeah, of course. If Fastenal does the transportation for you, brings it, stocks the vending machines, the bins, whatsoever, you have in general a reduced cost. So the takeaway, right? The takeaway. Let me make it in my own words. So they have a resilient revenue stream because they fill up their machines. These guys are producing, right? They need these supplies to keep everything running, and especially by such a broad offering, their revenues have become less cyclical over time. Let's see, they're still cyclical, as manufacturing sector in general is cyclical, but less. They provide a lot of data for the manufacturers, and they provide a lot of cost saving by cutting out a lot of the middleman and saving them on, let's say, management, not management, but inventory management personnel. And also, the workers they're a bit more careful by in manufacturing, by like seeing more exactly what they use and knowing maybe that they are, let's say, being a little bit looked at, right? All right. So this is from the 2021 annual report, or 2022. I don't exactly remember. Doesn't really matter. What I want to show you here is like the locations, right? 1,400 on-site locations. The rest there in the, like just off-site branches, as I told you, the showrooms and the normal, which being the smallest part, and also the normal branches. They ship 90% through their internal trucking fleet. Of course, you will have a higher carrying cost because you need to take care of the trucks. Like I've talked about trucks and trucking a little bit with Old Dominion, but Old Dominion is not really affected by Fastenal transporting their own stuff, especially because I think Fastenal is not really doing a lot of less than truckload, but still. Um, so they're doing their own trucking, saving a lot of money by that long term, not as impacted by inflation, having to transport stuff with other companies like FedEx, UPS, and stuff, which have then, of course, more pricing leverage, would have more pricing leverage. Their inventory stays locally, so either they some local producers or a lot of products they're produced by themselves, which is very nice, very good pricing power in that. Also, right, and nowadays very good, let's say, inflation resistance. 43% digital footprint, which is also very interesting because compared to MSC Industrial and also Granger, MSC Industrial I don't think has any on-site locations, and Granger has like I think it's 18% vending systems, but they're not really like very keen on that. Their shares have performed a lot better over time, but it's also because Granger I think is a very like way older company, so it has caught the economy for a longer time. I can't really see a lot of like more quality there than in Fastenal. I'd have to look into it a bit more. Of course, you have to look into the competitors, especially in such a, let's say, mm, almost not monopolistic, but polypolistic industry. Of course, there's a lot of small distributors, but they're slowly getting bought up by those three. But still, I think the main reason, especially time, because Granger has been around for a long time, and also they concentrate more on their e-commerce offering. I do have a feeling. Anyways, here's the installed fast fan and fast bin systems, right? Okay. So here you kind of have a chart again about the offerings and the structure of Fastenal, not the share structure, but like the, let's say, operating structure of Fastenal. These are the branches, which also include the showrooms and the on-site location, which I found very interesting. I really like that they have pivoted to this on-site location part because I think long term this will be a um, very successful model, especially now as companies are looking to save a lot of money. So 56% of their revenue goes through this digital footprint, which is either e-commerce and it's different type of stocking systems, right? Um, Fastenal doesn't only provide customers with this type of distribution and inventory management systems. They also provide different type of services. I don't think a lot of their bottom line comes from these added-on services, but you kind of, as a distribution company, right? Over time, they have differentiated themselves as also kind of supply chain services company. But you also need some added-on services to attract and to keep the customers. You got to differentiate yourself. After all, it is a services business, right? So you need to have something better because if a guy next door is selling the same thing as me, well, both look the same, talk the same, walk the same, the customer is gonna pick the cheaper guy, right? But if I talk a bit nicer, offer him some, maybe clean his shoes for free, bring him some lunch, he's gonna buy it from me, even though maybe the price is even a few basis points more expensive, right? If the customer valued those the sandwich I bring him and the shoe cleaning for him, if it adds him any extra service, right? So what Fastenal does, they do typical like calibration, repair work, custom chain sling fabrication and inspection. Here you can see the chain. Custom logo, a little bit like kind of, I think Cintas does a bit of this too. Special assemblies, you can see here this rod being threaded through this metal piece. Hoist repair and certification, so different type of certification services I imagine with smaller companies, especially smaller companies, having problems with bureaucracy, this is a very good added-on service. Hose fabrication, lifting and rigging, tool repair and calibration again, well-to-length bandsaws, on-site safety training, also very interesting for smaller manufacturers, right? And also they do special necessity orders like different type of bolts, engineering services, special coatings, fastener hot forging. They also do like a special type of carbon steels or any kind of steels or any kind of metal alloys. If you really need them, they'll get it for you, right? They'll order that from whoever, Nucor or maybe Reliance Aluminum and Steel, right? And also they do different type because there's bolting standards. So for example, for this, I think it's an oil rig, oil rigs or let's say aerospace rockets like SpaceX, right? They have different type of requirements or not necessarily requirements, but also like of course the ISO and the IEC say requirements, but also maybe they just want better standards than the normal threads, which have a certain percentage of let's say not impurities like imperfections, like they're not perfect within a certain percentage range per thousand, per 10,000, whatever. So you might need a certain type of accreditation when having such brute force or corrosion in the sea or brute forces like aeroplanes, rockets, and so on and so forth. And Fastenal can provide those type of services, which is a very good add-on and which might make those companies add their vending systems to them, which then get filled with this type of stuff. Right? Okay. So as I said, it's not only like a numbers game. Of course, it's a numbers game. Uh, that's why I'm saying it's not only like with the bigger a business get, the more efficiencies you have. Like you can order more stuff, you pay less for the stuff because you have a like big amount that you order. But they have, as I said, like this strategic partnership, this services they add, the job set solution, enterprise solutions, metalworking, the inventory solutions, which is like their creme de la creme. Um, Safety, government, bring a deep understanding of the government procurement process to create value for state, local, and higher education customers. So they also have a government customers and also the engineering. So they kind of not only sell them stuff, they also help them produce stuff, become better, so they can sell them more stuff in the future, right? That's what I'm trying to say with this. Um, as I said, for me, of course, there's little details you'll have to look yourself in the 10K and so on and so forth. But for me, the one of the biggest tailwinds is the it's not a tailwind, it's like the most important part of the strategy is the excuse me, the in-market location count. So the the branches, the off-site branches have been going down. The on-site branches have been growing and growing and growing, right? The total count, of course, has grown. That's what I like. I want these to go down and I want these to go up and up and up. Why? Because these have higher margins, they add more value to the customer, they have cost saving for the customer while having margins. It has a lot of software, a lot of data implemented into it. Like it's pretty much good back and forth, right? Well, this has not so high margins, but it's still also important to add like those to be able to provide those different services, and also still have some kind of human interaction with your customers, and also especially the showrooms. I think they should not really get rid of those, but as far as I've seen, they're not getting rid of the showrooms. They're more getting rid of the traditional branches. This is kind of confusing. It goes from right to left. It's from one of their reports. So net sales have been growing, and the branch locations, as I've told you, they're going down, but the on-site locations going up and up, and also the average monthly sale per site is growing. But even the average sale per branch is going. So the whole business is growing, even though the amount of branches is going down. And of course, the revenue is not going to grow as proportional because the uh, amount of branch locations is going down. But the revenue per branch, so the ones still existing, are actually still creating value. So at this point, they can even first close down the ones which are not creating as much value, which is also really good leverage to increase margins and other revenue, which I think probably consists of those added-on services. And of course, as I said in the previous, as I shown you in the previous graph, the total and market locations going up. Here's a little bit of their balance sheet. Like I really like to use this graph. It's simple, no like uh, no unnecessary stuff. Of course, you have to look deeper into it before yourself, but so here you can see total assets growing, which we like. Liabilities staying the same, even going like maybe going a bit up. Great, maybe here doing one or two acquisitions, right? Having to manage your cash, your liquidity, but still in a very healthy level. I looked also into their leases. They don't have that many leases, so that means they own a lot of um, their locations. Here you can see total non-current asset that includes their production facilities. They also have quite a lot of written off like locations. So because they're such an old company, they are actually have accrued a lot of written off value, which is good, saving taxes, right? Not those bad write-offs, like those normal write-offs you do every year. They have quite high inventories, yes, but of course they need to have the inventory to be able to distribute their product. And here, what I like the debt, they're managing their debt very well. Even when they leverage up a little bit, they pay it back down. Net debt is really manageable compared to the total current assets, to this, especially to the equity, right? Um, Book value, of course, because there's some debt, it's quite low, but not that much. And also because the market is paying a premium for this company. We'll see some reasons why. So here's the cash flow statement. So these are the most important, or these are the part of the cash flow statement. And as I always say, I think in every video, you really need to look at the cash flow statement. Don't look that much at the EBITDA, your EBIT. Maybe that's good for some ratios, but at the end, especially the free cash flow is what is going to give you your returns. If this number doesn't grow, I will bet with you that this, if this doesn't grow, you will lose money. This has to grow. Only if there's some kind of multiple expansion of some kind of asset play or some kind of buyout, then you'll maybe make something. I don't know. I'm not a financial advisor. Also, this is not financial advice as always, but I I I'm not gonna bet on that on something that I'm not gonna bet that this is gonna go down. I want this to go up, right? And I really like this chart. It's a very good chart because cash from operating activities. So the business is growing, which I like a lot. Here you have little corona worries or whatever this was, and but it's gone back up, which is perfect. And cash from financing activities is going more and more into the negative, which is also a good thing because that means, what does that mean? You are getting your dividends and the stock is getting bought back. Either both or just one of them. Depends what kind of company it is and what management thinks of capital allocation. In this case, it's both. Fastenal has even started paying special dividends because it has a lot of cash. It doesn't want to have that much cash on the balance sheet, which is okay because they can run their daily business. They have enough working capital, and their debt is really manageable, and they can get cash very fast. You can see here from operating activities, right? And also, they don't have that much capex, especially with this on-site branches. They require less capex, so the margins are going to go up. Really good cash flow statement. Current cash flow statement, perfect. Um, Here we have a lot of numbers. So their market cap 37 billion. Employees is actually a bit. I think this is not updated. This is our the margins. Really good margins, right? Really good. Free cash margin is 16% free cash flow margin. High ROE, which I really like, 32%. Return on capital employed, return on invested capital also very high, which is according to the ROE, right? Of course, yeah, they should be high, except it's if it's a bank, because they have different type of capital procurement, which is from customer deposits. Um, PE is quite high, right? PE is quite high above the S&P 500 median. But as I said, there are different reasons why that is so high, as they can still have quite a bit of margin expansion. Their on-site location is growing. They're saving costs for the customer. They're providing a lot of data for the customers, saving time for the customers, providing a lot of value-adding services, right? That's why this is valued higher. There are times when this number goes down, but that's only usually during recessions, and it also doesn't go down that much. Maybe there is a 30-40% contraction of the stock price, but that's not going to happen very often. You're not going to time a recession very often. So you can see revenue is growing, especially the last 3 years. It's going quite nicely. Probably a little bit of COVID come back, and also the on-site location growth. And here you can see in the earnings. This is especially going to hit the earnings, not that much the revenue, because I don't think the revenue will go up. Of course, it will go up. It's just the earnings will go more as the earnings will go up more as a percentage because I think that the margins will especially expand through this on-site location growth. Um, Long-term growth estimate 10%, which I see as realistic, depending on how the American economy manages to do long-term, which should be quite good, no matter which direction they go, if they're green or green energy or gray energy or whatever it is. They'll still need this type of manufacturing products. Um, Here you can see the dividend yield is on the high because they have been paying a special dividend, year 71% payout. And debt to equity, as I showed you, net debt is quite low. So their debt to equity is also very low. So great numbers, great margins. Valuation is of course quite pricey, but there are the reasons. Of course, have to decide yourself if that is fair or not. I just use the PE ratio as let's say a way to understand the market. Sometimes it's very difficult to understand some people. I think the PE ratio is a thing to understand the market. It, without context, especially context I've showed you before, the PE doesn't really have a lot of value for me. You really need to learn more as why a company has a PE of 4 or a PE of 30. A PE of 30 can be very cheap, and a PE of 4 can be very expensive. So always be careful when looking at the PE. Of course, PE ratio again, if we're going to state it. So it can vary depending on the growth of the company. But here you can see in the recession and also like in the times where manufacturing is not really growing, it's low. Here's the COVID goes down to around 25, even lower if there's a big recession. The median PE has been 30.26. Right now we're at around 32, so a little bit above the median, which I must say, right now looking at the macro environment, it's actually a little bit on the expensive side. Maybe the market is valuing the on-site location like very highly, but still it's kind of an expensive side for my liking. Um, but I still keeping a very close watch on this company. Maybe let's look at the share price appreciation. So you can see from the IPO, I think they had 1 million shares starting on 87, and 100,000 of those went to the employees, which is quite nice. A little story about that. Bob Kierlin got a call before the like a few days before the IPO from an investment bank, and from the roadshow conference, they had like a let's say certain price they were seeking. And the investment banker told him, "Hey Bob, like, what are you doing with the pricing, man? We can't." It was even the night before, not a few days before. What are you doing with that pricing? We can't like get you 3 times the amount that you're asking for. And he said, "No, my employees know that they have a bonus with options to exercise, like stock options to buy the stock. We're not gonna do that." Like that's what I also like about these type of founder CEOs when they have a high integrity, personal integrity. Like not thinking about those few cents in the short term, but because this is those few cents in the short term, they don't create a lot of value, but that personal integrity does this, right? Um, all right, let's maybe move on to some risks. As I said, before recession. But another risk. This is Morningstar, a risk which has kind of been debunked. So from 2012, Amazon supplies foreign the industrial distribution business will pressure industry gross margin. Um, yeah, monopoly like fastener distribution business, blah, blah, blah. This hasn't really happened, as you can see. So, because this has happened, right? You can see 2012. Yeah, you could have made a lot of money if you bought this. Of course, not financial advice, but if you look at the past, why hasn't this happened? Well, because Fastenal has added on services, has built out distribution centers to be able to compete with Amazon, and Amazon doesn't have their sales specialists, their value added services specialists, right? That can weld and produce different type of standard threads. They can just buy stuff from China or wherever. Not that China is bad, but they they can produce the same type of experience as Fastenal. That's why since 2012, Amazon hasn't really been able to compete in this field with Fastenal or any type of industrial distributor on the level they have wished for. Of course, Amazon very successful company, but not in hasn't been able to beat Fastenal in this aspect. So I'm not really afraid of e-commerce or any kind of new type of business. Maybe if there's a special element like drone delivery, whoever knows. I don't think they'll be successful in this industrial distribution or industrial services. But anyways, so I don't think there's a risk from at least any competitor outside of the typical industrial distribution services uh, right now, or industrial distribution in general, like MSC Industrial, Granger, but Amazon and stuff. No, I don't really see them as competitors. What is the risk, which you can't really calculate? You can kind of maybe a little bit think about it, but you can't really predict it 100% because the stock market is always like sometimes a drunken man, and it doesn't really. Sometimes it doesn't price in recessions. Um, but recession is a risk for Fastenal. Yes, the price, as I said, goes down 20, 30, 40% depending on the severity um, of the recession. It has multiple re-rating downwards, right? Can go from their 30 to their 20s, right? 25. And that will hurt them, but you can't really predict this risk. And that's why maybe you should try to buy Fastenal when it's not too expensive. Might be good a little bit above the median, but double the median probably might not be good, right? Now let's talk about some tailwinds. So we talked about headwinds. Now let's talk about the tailwinds. Because I think any kind of company working in a certain industry, they need some kind of tailwind to succeed long term. Otherwise, they're not going to do it. It's like Warren Buffett says, like interest rate works like gravity on equities. I think like tailwinds act as anti-gravity, as a rocket for equities. So onshoring. The companies bringing their factories from Southeast Asia, China, India, wherever, bringing their factories back home to the U.S. And this mentions of onshoring, same as AI, they have gone up a lot. So companies, especially because of the Inflation Reduction Act, a lot of tax rebates and incentives going to manufacturing, clean energy, also manufacturing, transportation and infrastructure, clean fuel in vehicles, clean energy, electricity. You need fasteners, you need janitorial supplies for your production facility. You need safety equipment, right? All of these, they're all kind of manufacture, repair, maintenance, so on and so forth. So they're going to need Fastenal products, and those are the onshoring combined with the Inflation Reduction at the low energy prices in the U.S. A lot of companies they're going to move their manufacturing to America, and I think this is going to be a really good tailwind for industrial distribution sector in uh, in America. Yeah. So guys, thank you for coming back again. And I hope I could give you some value with this video. And as always, it's not financial advice. Um, these are only my opinions, and for educational and entertainment purposes only. And have a good one. Okay, see you next time.